Hello everybody and welcome to the Tortoise channel. Happy to have you join us. Today's video is on discounted cash flow and reverse discounted cash flow methods, both of which are used to put a value on a company, okay? Because the value of a company is what? Is based on how much cash flows the business is going to project in the future. It can be 5, 10, 15, 20 years from now, discounted at the present value, okay? But then that is the DCF, and then we can use the reverse DCF to do what? To determine what is the current growth currently implied in the current stock price, right? And if we think those growth assumptions are reasonable or not. So stay with me for the next few minutes as I break down everything that you need to know. As always, thank you so much for the contributions, for all the feedback that you guys have been offering. And don't forget that at the end of this month we have our second live webinar, so it will be awesome to get your stock suggestions. I mean, if there is something that I can help you, just then make sure that you join that call, because it's going to be nice for me to actually understand who some of you guys are and whether I can contribute to your education as well. Okay. So let's jump right into it, guys. And the first thing we need to understand is I need to give you some background, okay? Because for me to just tell you about the DCF, but then you guys don't really know what the components are, so it might feel a bit overwhelming. So let me just try to explain from the very beginning in simple terms, all right? So this is a presentation that I prepared for my clients, but I will share it here with you as well. So I will share the slides. I will show them to you right now. So if I go here to DCF, let's start with this one and let me minimize this. Okay. So what is the point of calculating of using this method in the first place? So when do we use it? It's more suitable for valuing businesses that have stable and predictable cash flows, high growth potential, or significant competitive advantages. As a matter of fact, you can even use the DCF for companies whose cash flows are bumpy, for example, Amazon. And I will give you an example as well. I will give you examples in this video right here. So make sure you watch it till the very end. Okay. But instead of using free cash flows, for example, in the case of Amazon, we'll be using other metrics like net income or operating cash flows. Okay. So I will talk more about that ahead. So the DCF, the point here is it estimates a company's intrinsic value, how much it should be worth based on future cash flows. That's what valuating a business is all about, right? We want to know how much we can get how big a return we can get on our investments. And the intrinsic value of a company is always based on its future cash flows discounted to the present value. All right. So projected future cash flows must be discounted to present value so that they can be accurately analyzed, because we have to consider the time value of money, right? So the point of the DCF is exactly to account for this time value of money, which is the foundation of this model. The main limitation, of course, as you will see, is that there is a heavy reliance on assumptions which may turn out to be inaccurate. So, for example, if I'm using 15% projected growth rates for the free cash flows, but then that is just a projection, right? There is no indication that it's going to be accurate. And that's why you really need a margin of safety. Because remember, investing is it's just a science as an art. And so it's important to understand how these dynamics work, which may turn out to be, especially when trying to predict cash flow several years into the future. So whenever I'm doing a prediction, right, I never go beyond 10 years because that's just too far out into the future. And I mean, I think 5 to 10 years is great. I do 10 years and I'm very comfortable with that. But then I put a 50% margin of safety once I get the real value of the company, as you already know, if you are watching this channel, if you have been watching my videos for the last several months. Okay. So time value of money, what the heck is that? This concept states that money today is worth more than money tomorrow, right? So we all know that. What's worth more to you? Is it $10 today or $10 in 3 years' time? There are several, so it's certainly $10 today. And there are several reasons for that. Number one, for example, you have uncertainty, because if you give me, there is no guarantees that you're going to give me those $10 in the future, right? And so you want that money today. That's one reason you will want that money today. You don't know if I'm going to be able to pay it back to you in the future. So number one, we have uncertainty. Future money is definitely not guaranteed. Number two, another factor that we know very well, we have inflation. Money worth today is worth more than the same amount, say, in 5 years' time. Yeah, of course, because we have to account for inflation, and inflation, it destroys the purchasing power of our currency. So you will be able to buy less with that £10 in 3 years' time. That's just a reality. And number three, investing. If you take those £10 or $10, whatever it is today, you can put that money to work at, say, 10% per year. And then in 5 years, in 3 years, when I say I would give you those $10, right, you will have more, because your money would have, you would be putting your money to work today. You will be collecting that 10% compounded annual return. And in 3 years' time, that $10 will be already, I don't know, $30, whatever. So the point here is that money invested today at a high rate of return will be worth more in a few years' time. Okay, exactly. Look at that. If you can invest that $10 today and say 10% per year, and in 3 years it will be worth $13. That's one more reason for you to want those $10 today instead of in 3 years' time. Okay. Note, these reasons explain why we need to discount the money to be received in the future in order to value a business more accurately. So now you already have a foundational understanding, right, of the DCF and why we use it, right? And you understand its limitations. So now we can start talking about its three main components, okay? The three main components include the discount rate. This is based on the cost of capital of the company. It's the rate of return one wants on the investment. For the sake of simplicity, I always use 15%. Calculating the WACC, which is the weighted average cost of capital, it can be tricky, especially if you are a beginner. What I always do, and I know how to calculate the WACC, but I always use 15%. That's the money that I want to discount those future cash flows at. Why? Because, as you know, I want to double my money every 4 to 5 years. And so I always use 15%, regardless of which company I'm analyzing. Okay? Then you have the cash flows. Of course, cash generated by the assets of the business, available for distribution to all providers of capital. And then you have the number of periods. In my case, I like to do 10 years of projection, as you already know. And so I try, that's the number of years that I use, in which the cash flows are expected to occur normally 10 years, as that's the average lifespan of a company. Okay, so I never go beyond 10 years. Cool. Let's talk about the discount rate. So you already know that. So it should reflect the riskiness and uncertainty of the investment. The TVM, so the TVM and company's ability to access capital. So a higher rate implies greater risk, but also more upside potential. So the greater the rate at which you discount those cash flows, the lower the intrinsic value will be. It makes sense, right? Because you are factoring in more risk. Okay, and that's why when you use a 15% as your discount rate, you're going to have to be more patient, especially if you want to buy high quality companies with that margin of safety, because it's not every day that these great businesses become cheap, right? So now you understand that. Typically, the discount rate is the company's cost of capital, as we saw, or the price a company incurs to borrow money. That costs or raise capital from investors to fund its operations. So stick with 15% if you are just getting started, and you can't really go wrong because you are already factoring in a lot of risk, so you will have a margin of safety. And if you stick with high quality companies, that's key, then chances are you will do very well. Okay, that's discount rate. Then we have the present value. Okay, this is what? This is an estimation of how much a future cash flow or stream of cash flows is worth right now. So all future cash flows must be discounted to the present using an appropriate rate, as we already saw. That is the discount rate. That will reflect the expected rate of return and risk profile because of the time value of money. So lower risk, lower discount rate. This leads to a higher valuation. Okay, higher risk will lead to a higher discount rate, which will lower the company's valuation. Okay, cool. So then we have the future value. While the PV, the present value, calculates how much a future cash flow is worth today, the future value is how much a current cash flow will be worth on the future based on a growth rate assumption. So we use it to project the value of an investment in the future. I will show you how this looks like in the model once we jump into that. Okay, and then we have the terminal value. So the TV determines a company's value into perpetuity, because what happens is, and you have to ask, we are doing a 10-year projection, but what happens after those 10 years? Does the company die? No. Many companies continue to grow at about the same rate that the economy does, which is usually around 2.5%. Okay, but this is where you have to factor that into the model, and that is something that is captured by the terminal value. It helps you estimate the value of a company and the revenue it can generate past the forecasts for future cash flows. Okay, it's calculated by dividing the last cash flow forecast by the difference between the discount and terminal growth rates, and this is what the model essentially would look like. But I'm going to show you exactly. We already discussed some of the issues. Okay, so we have the fact that well, there are growth assumptions that can be there are a lot of growth assumptions that are built into the model, which of course caused it to be not fully accurate. Yeah, which makes another case for the margin of safety, as I already told you, and this is what you can see right here. Always apply this, because we should only buy when the stock is trading at a percentage below our calculated intrinsic value. Okay, typically anywhere between 20 to 50% below intrinsic value. I like to do at about 50%. Okay, so the less certain we are about the intrinsic value, the higher, so the bigger should be the most we should apply. Most stands for margin of safety. Okay, cool. So let's let me show you exactly what the model looks like, so you guys can see. And this is what it looks like. Now I will, because you guys asked me, and in particular the person who asked me this, let me make sure that I spelled the name correctly. And let me see right here. Let me see. Merry Christmas. This was 13 days ago. Where are you? Where are you? Pinterest, a friend. Right here. Okay, so White Woody number 7. Is there a way to get your intrinsic calculator, friend? Okay, so I'm actually creating this video for you after your request. Okay, so I will share this template with you all. Okay, and you can use it at your own will. But it says here reverse DCF, but let's disregard this for a second, okay? Because this is something that we will tackle after we tackle the DCF first. And you can see that they are closely related. But let's start right now with the DCF, and you will see you will now be able to put into practice everything that I just discussed. Okay, all the theory. So you can see right here. Let's say we are doing an analysis of Amazon. Okay, so Amazon is right here, as you guys can see. I'm sharing my screen right now. Why is this? Hold on a second. Okay, and the first thing that I want you to know is that we have to think about this. So what metric should I use? Should I use the free cash flow? Should I use the net income for the DCF? It really depends on the business. And that's why I'm doing an analysis of Amazon just to provide an example, because Amazon's free cash flows are quite bumpy. If you go here to the financials, and if you go to here to the cash flows, we want to see predictability in the numbers. And now you guys understand why I like to invest in well-established, predictable companies. Because if you give me a company whose earnings or free cash flows are quite bumpy, how are you going to be able to project those earnings or free cash flows out into the future? It makes everything a lot more complex, right? And so if I go here to Amazon, let me go here. Okay, let me show you here what I mean. If I go here to the financials, let's go here to the free cash flows, and look what the free cash flows look like going back all the way to 2012. You see what I mean? So it's bumpy, isn't it? And there is a good reason for that. The reason for that is that Amazon reinvests a lot of its free cash flows back into growth. The company is still growing, taking over the world. And so you have to ask, does it make sense to use free cash flows in the case of Amazon? Probably not. Okay, because that wouldn't give you an accurate picture of the company's actual free cash flows, right? And so look what happened. 2014 it was up, then it came down, then it was up, then it was negative. Okay, not the best metric. So we want to look for more consistency and predictability in the numbers. This is what the free cash flows look like. Let's have a look at the cash from operating activities. Okay, so it looks a lot better right now. You see, look at that. Look at the consistency over time overall. Okay, so this already looks better. Let's have a look at net income. Okay, also looks better if you ask me compared to the free cash flows. So you can either use the operating cash flow or net income, because I think whenever I prefer to use net income. Okay, so in the case of Amazon, I would use net income, and you can see that the trailing 12-month figure, if I click this here for Amazon, bear with me, so I can see that the trailing 12-month figure is about 70, right here, 76,482. So that's the number that we will be using. I can come here, okay. This is Microsoft, but because I use this for Microsoft, but let's change that to Amazon, so you guys don't make the mistake of confusing things. Why is this not rename? Yes. Oh, sorry. Okay, let's Amazon. Okay, cool. So let's start right here. The free cash flow in year one, you will be using this. So pay attention, because as I populate the cells, because you will be using this template for your analysis as well if you decide to download it. So the free cash flow in year one, in this case, we are using what? We are using net income. So it's going to be about 76 billion. So instead of free cash flow, you can have net income. Okay, make sure you just change that net income in year one. All right, and now we want to see how the number of shares outstanding. That is also important. So if I go here to the income statement, and if I go here to shares diluted, you can see we have about 10 billion. So that is the number we will be putting right here. Okay. And then we have the perpetuity growth rate that we discussed already in the slides. This, remember, is the growth rate of the economy the growth rate of those free cash flows, in this case, the net income, after our projected 10-year period, okay, which is about in line with the overall economy. So you can just leave 3% right here forever, okay? Your desired return, this is the discount rate, as I already told you, is always 15%, so you can leave it here as well. Now, what's the current stock price of Amazon? And if I go here, I can see it's 242, so that's the number that I will put here, 242, okay? Cool. So now, in terms of the growth rate, So this is the net income in year one. But now what we want to see is we want to grow that net income at our projected growth rates over that 10-year period, right? And you can see that the above cells where you see free cash flow right here, which in the case of Amazon will be net income, what these cells will tell you, bear with me, right here, this is going to be the future, right? Look at that. So right here, this is where you see right here, this is the future value of the free cash flows, what we discussed as future value. You know, the only thing we are doing right here is compounding the net income in year one at our projected growth rate right here, okay, and that will and then it just compounds over time over that 10-year period, okay. And then you have the present value below, which is this which is going to be the future value of those free cash flows, right? Discounted at our projected growth rate. And you can see that all the formulas are already built into the template. So if you really want to know how to do them manually, you can just click on top of the cell. You can just come here and you will see where it's getting the information from. Okay, so we have the discount rate, our discount rate. We have the growth rate of the free cash flows. We have the future the future value of those free cash flows and the present value of those free cash flows. Okay, so what about the growth rate? What is the growth rate that we should be putting here in the case of Amazon? For that, there are two things that I like to do. You can go back to the last 10 years and see what has been the growth rate of Amazon's net income over that time. So, for example, in the case of Amazon, if I go here to stock and lock, I can see that since 2015, where is 2015? Okay, right here, I can see that the net income has grown at about 64.48%. Okay, so you can use that as well. But what I really like to use, for example, is then to compare this with what analysts are projecting. And typically, I use the most conservative of those assumptions. So, for example, if I go here to Amazon, if I go here to forecasts, and if I go here to statistics, you can see, for example, that the earnings per share growth forecast for earnings, so the earnings per share includes buybacks, so it's not really, it doesn't really tell you about net income, but what happens over time is that, look at that. So while net income has grown at about 64%, you can see that earnings per share diluted have grown at about 63%, pretty much in line. Okay, because again, Amazon reinvests a lot of that, a lot of those cash flows back into growth, and so analysts are projecting about 20 to 21.38% over the next few years. That's the number that I'm going to use. Okay, because it's more realistic, and so you can put that number right here. Let's call it 23. Okay, and what's going to happen is that now, as you can see, so the net income is growing at your growth assumption of 23% per year over that 10-year period. Okay, and then what you can see is that the present value is already done right here for you as well. So we are discounting each of these figures back to the present value using our discount rate of 15%. And when it's all said and done, look, we have the perpetuity value right here, the discounted perpetuity value, because that figure needs to be discounted that future value needs to be discounted to the present value as well. And then we have the total equity value. Okay, and so what this means, guys, is that if Amazon goes on to compound its net income at 23% per year over the next 10 years and beyond, right, the total equity value in that case will be about, what is this? This is what, almost 2 trillion? It shouldn't be even 2 trillion. It should be more than that, I think. No, sorry, excuse me. It's actually almost 2 trillion. Okay, so this is it. And then if you divide that, and then to calculate the intrinsic value per share, which is what we want, what do? We just need to divide this figure, as you can see, by the number of outstanding shares, and this will give us an intrinsic value of our $181 per share. Okay, that's it. That's all it takes. And so if you believe analysts are correct about their expectations, and if Amazon does go on to meet them, then the real value of each share is about $181, and that's the price you should pay. Because Amazon today trades at 242, this means that we don't have our margin of safety right here. In fact, we don't. In fact, it's not even that. The company is well overpriced, so it's not even trading at our intrinsic value, which is 181. Let alone, a margin, let alone having a margin of safety. Okay, so this is it. This is how I do stuff. So gave you that example, and yeah, and now with the reverse DCF, but with the reverse DCF, all you are asking is right here. You can see that in the template as well. A reverse DCF shows us the expectation that are implied in the current stock price. And what we are trying to determine as long-term investors is whether those expectations are realistic or not. It's even simpler than the DCF. All you have to do with the reverse DCF is you want to know, okay, so what is the current expectations built into the stock price? Amazon currently trades at 242, and our intrinsic value per share sits at about 181. So what does that tell you about the growth rate? It means that the market is implying a higher growth rate, right, than 23%. And sure enough, if I adjust the 23%, so if I change this to 25%, the intrinsic value per share will increase. Look at that. Okay, now we are at 204, but look, it's 244, so we have to continue to adjust that. Let's change it to 30. Look, we are already overshooting it, 272. So let's change this to 27. No, let's adjust it a bit further to 28. Boom, look, 242. So what the reverse DCF tells us is right now, the market is projecting, the market is pricing Amazon as though its net income is going to grow at 28% per year over the next 10 years. And what we have to do is, do I think this is reasonable or not? Okay, if you think it's reasonable, then then you could buy Amazon today. If you think this is well over exuberant, then this is not the price to pay. As simple as that. Okay, and this is it, guys. So this is the essence of the DCF and the reverse DCF and how investors use it. And in the case of Amazon, we use net income. But if you, for example, assess a business like PayPal, which is a free cash flow machine, right? Look at that. PayPal, look at the consistency of the companies, look at the consistency in free cash flows over time. So if I go here to the free cash flows, look at the free cash flows over time. Let's click here, yearly, boom. Okay, so this is a metric. In the case of PayPal, we could certainly use free cash flows instead of net income. Okay, because it's fair. We have a few bumps in the road, but remember that there are outliers like COVID, something that is only temporary, right? And that is certainly the case with PayPal. So overall, the trend is higher, and there is a lot of consistency as well. And sure enough, they have been compounding by about 15.67 per year as well, which is quite strong. So 6.7 billion is the number that we should that we could input right here in free cash flows in year one. Okay, that's it. So let's do the same for free cash for PayPal, and we will have free cash flow right here. Okay, same thing. So let's change this to free cash flows, and now the current stock price is about what? PayPal. The price is about 58. So 58. Okay. Shares outstanding. How many shares outstanding do we have? Let's go here to financials. Excuse me, income statement. And shares outstanding diluted 987. That's the number we will put right here, 987. We have our projected perpetuity growth rate, desired return. Both of these remain the same. What about the free cash flow? It's about 7.5 billion, is it not? Yeah. So if I change this to the trailing figure, they are projecting cash flows of between 6.5 billion and 7 billion in Q4, right? So I will use the I will use 6 billion and a half. Okay, 6 billion, like that. Cool. Okay. And what are analysts projecting? Remember, same thing. So we know that free cash flows have compounded by about 15% over the last since 2015. But what are analysts' assumptions? Let's go here to statistics, and you can see that they are projecting about 18%. I will use the most conservative, which is about 15%. Okay. And by the way, guys, just so you know, where you can use, so I don't like to grow cash flows or earnings at a number higher than 15%. And the reason for that is, for a company can certainly go beyond that. And in the case of Amazon, it in all likelihood they will continue to compound above 15%. But look, man, I'm a very conservative investor. Okay. And so I typically own, the maximum that I will go to is about 15%. Okay. Which is what we are using for PayPal right now. And what you can see is, okay, so all of that is correct. So what do we have? Boom. Intrinsic value about 106. Oh, look. So does this mean that PayPal currently at 58? Does this mean does this mean that we have a margin of safety? The answer is yes. Otherwise, PayPal wouldn't be in my portfolio today. So let me break this down to you. What it means, again, is that if PayPal really goes on to compound free cash flows at 15% per year over the next 5 years, over the next 10 years, then the intrinsic value per share is about $106 per share. $106. Okay. Today's price is at 58. So yes, we have, look at that. We have, so it's 83. There is an 83% upside potential right here. All right. Which is very telling. And by the way, don't forget that this model doesn't even account for what? Buybacks. Okay? Because buybacks is a way for the company to deliver value to shareholders, right? Because after all, they will decrease the number of shares outstanding as well. And that, of course, will increase the per share value over time as well. Okay, so that's one thing that will play that will work to our advantage, especially if we are talking about cannibal stocks. And PayPal has been a cannibal stock as well. It's been buying back stock like crazy. Okay, so I love this setup from a valuation standpoint, and I hope you managed to understand the model. Okay, so I gave you two examples, two different companies. We are already well extended into today's video, so apologies, but I really wanted to break it all down to you guys. And I will share this spreadsheet. So make sure that so that you can download it. And if you have other questions, just let me know. But this is one of the methods that I use. The other methods include the three methods that I learned from Philtown, and they are the margin of safety, the payback time, and the 10 cap rate, which I also discussed at length in one of the videos. But that template, right? So that one is designed for clients only. And so, and I won't be sharing that. However, I'm sharing this one right here, and you can do both the DCF and reverse DCF as well. Okay, so all formulas are included. Start playing around with it. Let me know if it helped you, and yeah, let me know what else you would like me to discuss in future videos as well. Okay, and by the way, if you want me to talk a bit more about the financial statements, what exactly are the metrics that I'm after, also let me know in the comments below so I can do that. Okay. Have a great day, guys.